Okay, excellent. Well, hello everyone, and welcome to today's Business Essentials webinar. This month, we're speaking with John Tucker, and so we'll get started with John in a second, but I wanted to also give you some announcements before we get started. Remember that you have the Q&A feature as always. If you have questions for the group during the presentation, go ahead and type them in to the Q&A feature. We'll be watching that. Remember also that as you heard at the beginning of the presentation, we are recording these sessions, and you can always watch this Business Essentials webinar or any previous sessions on our website. Just go to the Business Essentials page, and all of the webinars that we've produced in the last 2 years are available. And don't forget also, for those of you who are FCSI consultant members, these webinars do count for 1 CEU credit. So please also share that information with your colleagues who may still be looking for credits to finish out 2021. And now we can welcome John. Take it away.
Great, thanks. Hi, everybody. Thank you for having me on today. My name is John Tucker, and I'm a principal here at KBKG. Also on the phone, I have Todd French, who is one of our regional development directors here at KBKG. And I'm going to let Todd introduce himself in the firm.
Excellent. So KBKG is a specialty tax firm that's been around since 1999. And what that means is we're not going to do your traditional tax returns or audits. We stay in a very narrow lane as far as our potential services. If you look over here to the right-hand services, where these are the services we provide. I mean, we're going to be focusing more on the R&D tax credit side of things because that's where we can help you folks. But we also help with accelerating depreciation on investment properties, any of the green incentives. If you're helping with if you're selling your services from the U.S. or internationally, possibly IC disc and transfer pricing could work with you. But again, we're going to focus more on R&D tax credits for today.
Perfect. Well, as I mentioned earlier, my name is John Tucker, and I'm the principal here at KBKG, where I oversee the R&D tax credit practice. My background is I've basically been doing R&D tax credits since I graduated college. I went to the University of Georgia, and I sit in Atlanta, Georgia currently. So I know all of you are probably kind of all over the place, but that's where I am. But we do have offices all over the country and professional servers all over the country that can help with these various services that Todd alluded to. But I am the R&D tax credit specialist here. And so today we're just going to kind of go over high level, what are the benefits of an R&D tax credit? What is the definition of the R&D credit, what you need to consider. There's audit considerations. Now, I know this may not apply to everyone on the phone, but it may apply to some of your clients or individuals or companies that you may be consulting with, right? So audit is always something to consider. And then there was a recent development with the IRS, which we call the Chief Counsel Memorandum, that came out within the past month or two that I'd like to discuss, just in case you've heard about the R&D tax credit and how it may have changed in the past couple months. So what are the benefits of an R&D tax credit? So the R&D tax credit is a dollar for dollar credit that reduces your tax liability on your tax return. So a deduction reduces your taxable income, and then you pay tax on that taxable income. A credit reduces your actual tax liability, like I said, dollar for dollar. And then I'm going to go over what is the definition of R&D and what are qualifying expenditures. But just to give you an average, generally for every dollar that you qualify, there's going to be anywhere between 7 to 10% back in an R&D tax credit. So when you start thinking about the types of dollars that are eligible and how much you're spending in these areas or how much your clients are spending in these areas, you can use that general rule of 7 to 10% to see if you think that is a sizable number or a number that interests you in claiming an R&D tax credit. Something else to consider is there are state credits available in addition to the R&D or the federal R&D tax credit. Anywhere between 37 and 38 states do have R&D tax credits. And of course, that changes year over year, depending on state legislatures and how they change their laws, if they repeal the credit or add a credit. But generally speaking, it's always 37 to 38 states. So depending on the states that you're performing some of these activities in, there could be some state R&D tax credits. Also, another thing to consider is this is an annual credit, so it's not a one-time thing. So as long as you're continuing to do the R&D activities, which again, I'll explain what that definition is here in a little bit. As long as you're continuing to do those, you're eligible to claim this credit year over year. And not only are you allowed to claim it in the year that you're calculating your tax return and calculating your tax liability, you can also go back to any open tax year and claim any missed credits that you have missed in those prior years. So it's not just in the current year, there is the opportunity to go back typically up to 3 years of prior year's tax returns. Then also, to the extent you are not able to utilize a tax credit in the year that you claimed it, let's say you're in a net operating loss position, or your clients may be in a net operating loss position, the R&D tax credit carries back 1 year first. So you can go back and claim a refund in a prior year for that credit that you're calculating, or if there's no tax liability, you can carry it forward to up to 20 years. So this isn't a use it or lose it type deal. Although I guess if you did were not able to use it within 20 years, you would lose it. But more likely than not, you're going to be keeping these credits and utilizing these credits within 20 years. So it is a benefit that you would want to claim every year, even if you're not able to utilize it in the current year, because you may be able to utilize it in a future year. This next slide kind of represents the overall population of individuals and companies that claim R&D tax credits. The largest part of the pie, as you can see, is companies that have greater than $100 million of revenue. That is the vast majority. Because historically, most companies, most individuals believe that R&D has got to be kind of the white lab coats, test tubes, beakers, that type of stuff to qualify. So you're talking about the Mercks, the Johnson & Johnsons of the world, and not necessarily the smaller businesses. As you can see, the smaller businesses less than $100 million revenue only represent about 13% of all R&D tax credits claimed in the United States. We expect that number to increase year over year as people become more familiar with the rules and how it applies to various companies. In addition, there are some more favorable rules for some of the smaller companies or startup companies out there that didn't used to exist that can make this share of the pie bigger. But that's just to give you kind of a frame of reference of who is claiming the credit and where the opportunity lies. This next slide talks about what types of industries claim the R&D tax credit. So as I mentioned earlier, most individuals think they have to be white lab coats, test tubes, and beakers in order to qualify. But in reality, the industry that claims the biggest amount of credits is the manufacturing industry, right? So 61% of all R&D credits claimed in the United States are in the manufacturing industry. Not even a close second is information services, which is like the Googles, the Apples, things like that, the IT type world. So you would think that would be higher, but again, manufacturing is huge in the United States. And in fact, the R&D tax credit was originally put in place for manufacturing. It was originally put in place for the big three automotives in the early 80s, for the GM, Chrysler, and Fords, when a lot of the inbounds, a lot of Japanese and Korean inbound automobiles were starting to take over market share and were innovating faster than the big three automotives here in the United States. So this R&D incentive was originally put in for manufacturing. But this goes to show you that you don't have to be in that high tech, high science area in order to qualify for the credit. Mentioned earlier that a number of states do have R&D tax credits currently. The states shaded in red are the credits that are the states that have credits currently. The gray ones do not. And again, any given year, one may fall off or one may be added. So it is always good to stay on top of that and understand, but mostly it stays pretty consistent. And of course, the rules are different in each state on how you calculate and qualify for the R&D tax credits as well. But that is something we are familiar with. We're familiar with all the states and all the credits and how to compute them. So we do help our clients understand if they're eligible for those credits. The key here is when I go over the definition, the activities or the R&D activity has to take place, physically take place in that state. in order for you to claim the credit. Not necessarily if you have tax in that state, you just have to be performing the activity in that state. So now I'm going to kind of go over what is the definition of R&D, high level. And I guess I should say, if you have any questions, feel free to raise your hand. I think Amy's monitoring that and she'll interrupt me. I can't really see the dashboard if anybody is asking questions or things like that. So definitely chime in if anyone has questions, if you need me to stop, slow down, or re-say something.
Yeah, and I sent that in the chat as well. So everybody got that message too. So if they have any questions, we'll do our best to, I'll either answer them or John will pick that up at the end.
Great, perfect. Okay, so the R&D tax credit. This slide represents the definition of R&D from a high level. So the R&D tax credit is an activities-based credit. So it's going to be based on the underlying activities that companies perform. So this could be yourself or this could be some of your clients, right? What you want to understand are the activities that companies are performing, and if an activity meets the definition of R&D. And you evaluate all activities. It's not just 1, 2, or 3. It can be any of the activities that they're performing. And it's not an all or nothing deal either. 1 or 2 things can qualify and 4 or 5 cannot, right? So you just kind of evaluate all of them and determine if those activities meet this 4-part test. That's what we call it, the 4-part test. So the first test is the activity's got to be technological in nature, meaning the activity's got to rely upon a hard science. These are chemistries, biology, engineering, software development. So anything that's reliant upon a hard science can meet the technological in nature. What we stay away from is the soft sciences. So marketing is not an eligible activity. So if you're trying to determine how to market a product or how to price a product so it sells more or creates more profit, that's not fundamental on a hard science. However, if you're developing an algorithm or a software application that helps you price products or anything like that, then the actual algorithm or the software application is what qualifies, not the actual pricing / marketing piece. So keep that in mind. It's got to be based on a hard science. The second test is the activity has got to meet what we call a permitted purpose, meaning the activity must be intended to develop or improve a product, process, formula, technique, or invention. So these can be brand new revolutionary products or processes that you've never done before. But more often where we see companies qualify is in that evolutionary or incremental improvements that they make to existing products and processes. So anytime a company is trying to make something better, faster, cheaper, stronger, more reliable, more functionality, that all can meet the permitted purpose test. So if you think about when I was talking about manufacturers or the largest claimer of the credits, a manufacturer might be making the same widget or the same car over and over and over again. But I guarantee you they're not making it the same way as they did in 1970 or 1990 even, right? So you're constantly evolving, constantly improving, constantly having to do with changes. So that all can meet and fall into the permitted purpose test. Then the third and fourth test go hand in hand with each other. What the third test states is at the outset of the activity, there's going to be some form of technical uncertainty. And so that can be in the form of capability, methodology, or appropriate design. Capability, meaning they have no idea they can achieve what you're trying to do. It's clearly a technical uncertainty, but where we see most companies qualifies in that methodology or appropriate design, meaning given enough time and resources, you're able to achieve what you're trying to do or develop. You just don't know the best way or the most optimal way to do it. So what you do is you go undergo the fourth part of the test, which is a process of experimentation to eliminate that technical uncertainty. And that's just some iterative process that you go through to evaluate alternatives or test hypotheses. They can be as simple as technical discussions, whiteboarding discussions, actual prototyping, beta testing, trial and error, just anything that's iterative in nature. It doesn't have to be formal. It's just anything that's iterative in nature where you're evaluating those different alternatives or testing your hypotheses to see if you can achieve what you're trying to do or develop. That can meet the process of experimentation test. And so if an activity meets all 4 parts, meaning it's reliant upon a hard science, you're trying to develop or improve something, you're not quite sure how to do it or if you can do it, and you're trying to evaluate different ways of doing it, that's the definition of R&D. And if that activity meets all 4 parts, then the activity is at least initially eligible for the R&D tax credit. There are exceptions, obviously, as there always is in tax law, there's always exceptions. I'll go over some of those a little bit later here, but at least the activity is initially eligible. So once you determine an activity is eligible, you need to start then to identify the costs that go into that particular activity. And there's 3 types of costs that are eligible for the R&D tax credit. The first cost is wages. And so this is wages that you pay employees that are involved in the R&D activity. It's not only the employees, but if you're a self-employed or you are a partner and you earn self-employment earnings from a partnership or anything like that, it doesn't have to be just a Box 1 W-2. But if you're paying yourself or you're paying your employees and you're involved in R&D, that's the first cost that is eligible for the R&D tax credit. This is typically the largest cost of most R&D tax credit claims. However, not always. Some companies have bigger supplies and contract research, which I'll go over here in a second. But generally speaking, wages is going to be the primary driver of an R&D tax credit. The second eligible cost is supplies that are used and consumed in the R&D process. So these are items that are tangible in nature, not intangible, but tangible, that are not subject to depreciation. So assets are not eligible for the R&D tax credit. So if you're using a computer to run modeling or things like that, a computer is considered an asset. Even if you've expensed it, it is still considered an asset that would be subject to depreciation. So it's really got to be those tangible items that are not subject to depreciation, those consumables. So if you think about a trial run or something like that, you might purchase raw materials or things like that you need to put together a prototype. It's those consumables that you can qualify for the R&D tax credit. Data does not count because that is an intangible, right? So if you're developing a software application and you're analyzing data and you had to buy a bank of data from somebody, that is not an eligible expenditure because data is an intangible. There is a supply cost that's not actually outlined here. It's what we call computer time sharing costs. May not apply to a lot of anyone on the call today. However, if you are doing some software development as an eligible activity, the computer time sharing cost, it may be an eligible expenditure. And what that is basically cloud costs. So if you're doing any of your development of your software application or algorithm in the cloud, then you may be able to pick up some of the costs that you're paying your cloud services. So Azure, Amazon Web Services, or whatever you may be using. So that's something else just to think of there. And then the third and final cost that is eligible is contract research. So these are third parties that are engaged to assist with the research and development. So they may not be employees. They can be 1099 individuals, or they can be companies that have been engaged on your behalf to do R&D, or they may be engaged to do testing or contribute to your R&D. So that's also potentially eligible for the R&D tax credit. So when you think about wages and who's involved, same with contractors, they're not only the individuals that are performing the R&D activities, we can also pick up the individual that directly supervises them and directly supports them. So there's 3 levels or 3 layers of individuals that could be potentially eligible for the R&D tax credit on the same activity. So like I said, the person actually physically doing the development, so let's say the engineer or the software developer, but the engineer or software developer supervisor that's in the meetings reviewing their work product, things like that, they could be eligible too. Maybe a quality assurance person that's doing testing or making sure it meets specifications, things like that. They are supporting that engineer or software developer. They too also could be eligible. So that's also important to keep in mind that there's 3 levels or 3 layers of individuals that can qualify. Same can be for the contractor if they're playing in that role of it, substituting as an employee. If they're a support or supervision, we can pick them up too in that. The one note here in contractors, if you think about the dollars that you're qualifying, you can qualify basically the wages dollar for dollar on their activity. But a contractor, you can only pick up 65%. So if you paid someone $1 and 100% of their time is qualified activity, you'd only be able to pick up 65% or 65 cents of that dollar in the R&D credit computation. So that's the other thing to note there. There is a slight haircut for contractors. So what are kind of some example activities? And I kind of went over some of them in my definition of R&D, the 4-part test. So design work, technical design work, CAD design, modeling, anything like that. That could be a potentially qualifying activity. Prototyping, obviously, if you're designing and building an item and you have to make a prototype, that can qualify. Testing, I mentioned quality assurance, testing applications, things like that. That all can be a qualified activity as well. So the key here at the bottom, I say success is not required. In fact, if you fail, that's even more evidence that it was R&D and more evidence that it was technically uncertain. If you go back to the third part of the test, having technical uncertainty. So you are not required to succeed in order to claim the R&D credit. You can succeed and qualify, and you can fail and qualify. As long as the underlying activity meets that definition, then you're potentially eligible for the credit. So like I said at the beginning, all industries can qualify. You don't have to be in any particular industry. You just have to be performing, or your clients just have to be performing what we call qualified activities. So you could be in any of these industries and qualify. So retail, you typically don't think of as a qualified activity. Well, if you're developing software, right, that could potentially be a qualifying activity. So keep that in mind as you're thinking about your own business and or your clients, that you just got to be evaluating your activities and determine if those activities are eligible. So I mentioned I was going to go over kind of high level, what are some non-qualifying activities, even if it meets the 4-part test. First thing, and I don't think I've actually outlined it on this slide, is it's what we call a boots on the ground credit, meaning that the physical activity and the person actually performing the activity has to be physically located in the United States or United States territory. So you cannot outsource any of the activity to say India or China or Ukraine. You actually have to be physically performing the activity in the United States. So even if it meets the 4-part test, if it's not done in the United States, it's not eligible. Now you can have part of the activity outsourced and part in the United States, and that's fine. So let's say you spent $10,000 or $100,000 on an activity, 50,000, 60,000 of it is done in the United States and 40,000 of it's overseas. You could pick up 60,000. You just can't pick up the 40,000. So keep that in mind. That's probably one of the biggest disqualifiers there that we see. The other thing is, you can't do qualified activity once you're in production, unless once you're in production, you're making enhancements or adjustments to it to make it better, faster, cheaper, stronger, right? So just because commercial production has begun doesn't mean you're ineligible, but you're typically not going to be qualifying any activities after commercial production. Debugging is something I like to talk about as well. I don't know how many individuals on this call are going to be dealing with software development. Debugging is kind of a bad word in the IRS's eyes when it comes to the R&D tax credit. And the definition of debugging is very specific in the tax rules. So thinking about what some engineers or some software developers may call debugging may not actually be the definition of debugging. Debugging is putting a certain application or product back to its original intended use, meaning there was no enhancement, no change, something just broke and you put it back to its original intended use. That's debugging. If, however, there is a bug, if you will, in the system or a bug that's making something not work right, but in the process of doing that, you're enhancing the speed or something like that, then it's no longer debugging, it's a qualified activity. So just wanted to outline a few things here that may not be qualified. Okay, so moving on, what should I consider in regards to the R&D tax credit after we know a high-level definition, high-level eligible expenditures, and some disqualifying type activities? Well, things to think about when it comes to the tax implementation of this credit. The Tax Cuts and Jobs Act, which was the 2017 tax bill that was passed that reduced corporate tax rates and changed some of other things in the tax law, made some changes that impacted the R&D tax credit. Most of them favorable, some of them not, but most of them favorable. But the two things I want to highlight here, and this may be a little bit in the weeds or a little bit more tax, but it is very applicable to you and or your clients, are what we call the 280C election and the alternative minimum tax. So the 280C election is a provision in the tax code that prevents double dipping. So you remember at the very beginning, I said deductions reduce taxable income, and then you pay tax on your taxable income, and credits reduce your tax liability, what your actual tax owed is. So if you think back to the expenditures that are eligible for the R&D credit, wages, supplies, and contract research, these are deduction eligible items as well. So what 280C is put in place for is to prevent double dipping, right? It's basically preventing you from taking a deduction benefit and a credit benefit on the exact same expenditures. And so what 280C allows you to do is either A, you have to add back to taxable income the amount of the credit that you've calculated. So if you have a $100,000 credit that you've calculated based on $1 million of spend, right? You go back to my general rule of 10%. That $1 million spend gives you a $100,000 credit. You would have to increase your taxable income by $100,000, thereby paying extra tax on that $100,000. So if you're a corporation, that's an additional $21,000 in tax, right? 21% of $100,000. If you're an individual in the top bracket, that's an additional $370,000 of tax, right? But then you get the tax, or sorry, $37,000 tax. My math was wrong. $37,000 of tax, but you get the $100,000 tax credit to offset that plus more. Now, what the 280C election allows you to do, which can only be made on an original return, so this is important why you would want to talk to a tax consultant such as ourselves to make sure you're making the right elections when you're filing your return, is you can elect 280C where you reduce your R&D tax credit by the highest corporate tax rate, and then you don't adjust your taxable income. So the highest corporate rate is only 21%. So if you're an individual at 37%, there's a permanent tax benefit built in with the Tax Cuts and Jobs Act. You're only giving up $21,000 of that R&D tax credit, and versus paying the additional $37,000 that you would have paid if you didn't make that election. So that delta between the 21 and the 37 is the benefit, or the benefit that's built into there. So that's something to keep in mind. 280C was a big change because of the corporate tax rate. AMT was eliminated in the Tax Cuts and Jobs Act for corporations, but not for individuals. So AMT is still very applicable to certain companies and certain individuals. The R&D tax credit traditionally is not allowed to be used to offset AMT tax. So any of your clients are in the internal alternative minimum tax situation, they would need to talk to us to see if there's a way for them to be able to utilize it, because there is an exception. You can see there I have in parentheses the qualified small business, which I'll go over what that was and when that was put into service. But generally speaking, there's no more AMT tax for corporations, so you're not going to be limited in those senses. But for individuals, that still could be applicable to them. So the PATH Act, this goes back to 2015. The PATH Act is where we talk about the permanent extension of the R&D credit. It used to be a temporary provision of the tax code since 1981. It's now permanent since 2016 forward. Payroll offset was put into place. I talked about how I was going to talk about how small businesses now may be able to take the credit more often. So if you think back to my pie of 13% of small companies claim the credits, this payroll tax provision is why. And then alternative minimum tax, which I just alluded to. There's an exception for eligible small businesses that was written into the law in 2015. So what is the payroll tax offset? So if you remember, I said if you didn't have any tax liability, you can carry it back 1 year or forward 20 years to utilize the credits eventually. Well, small businesses or businesses that are just start up typically aren't making any money or having any tax liability. So how are they going to be able to utilize the credit? So in that PATH Act that was passed in 2015, they put in a provision to allow these eligible small businesses, or startups, I should say, to claim the R&D tax credit against their payroll tax liabilities versus their income tax liabilities. So if you meet certain rules, you may be eligible to use the R&D credit against payroll taxes versus income taxes. So some of these startup loss companies or companies that aren't generating any income may be able to monetize some of the benefit for the R&D that they're spending. So what is an eligible startup? So that's what I call a 5 and 5 rule. In order to be an eligible startup, in the year you want to claim the R&D tax credit, you can't have had more than $5 million of gross receipts in that year. So let's say it's 2021. You can't have more than $5 million in gross receipts in 2021. And you can't have had any gross receipts in the 5-year period prior to 2021. So basically what this is saying is if you had gross receipts prior to 2016, you would not be eligible because that's more than a 5-year window. So 16, 17, 18, 19, 20, actually you can't have any from 16. So you can start having gross receipts in 17 because it's a 5-year window, including the year that you're claiming the credit. So if you started up in 2020, 2019, and you have less than $5 million of gross receipts, you may be able to make this election to convert this from an income tax credit to a payroll tax credit and be able to get a refund of all the tax liabilities that you're paying on the Social Security side of your employees versus saving it as an income tax to carry forward when you are taxable eventually. So also with the payroll tax credit, the way it's applicable is as soon as you file your income tax return for that year, the next quarter after you file it, you can start using that credit to offset the payroll tax liabilities. So if you file your return in March of 19, starting April 1, when you're remitting payroll taxes for those employees, you can start offsetting those payroll taxes in that April 1 Q2 and be able to utilize that on a go-forward basis. Once you convert the R&D tax credit for that particular year to a payroll tax credit, it's an indefinite carry forward versus the 20-year that I mentioned earlier. You'll be able to utilize that against payroll tax till it's all gone, even if it takes you more than 20 years. Hopefully it doesn't, but if it did, it's an unlimited carry forward when it's a payroll tax credit offset. Income, it expires after 20 years. AMT offset, I know I mentioned it earlier. You can't use R&D tax credit to offset AMT taxes. It was eliminated for corporations, like I mentioned, but individuals still may be applicable to the AMT or the alternative minimum tax. However, if you're an eligible small business, which was put into law in 2015 with the PATH Act, you would be able to utilize that R&D tax credit to offset AMT tax. What is an eligible small business? An eligible small business is basically a company or an individual that has less than an average of $50 million or less in gross receipts over the prior 3 years. So a great deal or a good majority of companies are going to meet this threshold. If you have more than 50 million, then you would not be able to utilize the R&D credit against AMT tax. Okay, audit considerations. So one thing, this is obviously a tax credit and goes on your tax return. So anything can happen with the IRS as it pertains to your tax return. And that includes R&D tax credits along with anything else that you're claiming on your tax return. An R&D credit in itself will not trigger an audit. So that I wouldn't worry about that. You know, that's no different than claiming any other credit or deduction on your tax return. But what could potentially trigger an audit is an amending return, right? So if you mentioned at the very beginning of the presentation, I said you can go back up to potentially 3 years. Some people can go back more, but that's a very unique circumstance. But typically you can go back 3 years and claim missed credits in those prior years. So right now you can basically go back to 18, 19, and 20 and claim any missed R&D credits or any credit or deduction for that matter on your tax return and get a refund for those. So anytime you amend your tax return to claim a missed deduction or credit, regardless if it's R&D or not, could potentially increase your chance of an audit slightly. Only reason that it would do that is because it's another administrative task the IRS has to go through. It has to cross someone's desk. They have to review it, sign off on it, and issue the refund. So it's just another touch point with the IRS. So that's why there's a slight increase in the in an audit. Does not mean it will be audited, but it could potentially happen. And so you got to be prepared for that. And when you claim an R&D tax credit on an original return, the risk is lower of being audited. It'd be more like a random audit if you filed on an original return, just like anything else, right? If you file on time, it just may be unlucky and you get selected for an audit because there are always random audits that happen every year as well. But generally speaking, if you get on an original return, that's always the best case scenario. And the audit risk is much lower then. But if you're amending, you are entitled to amend and you're entitled to take that credit or deductions that you missed on your return. It's not anything to be afraid of. It's just it's potentially that you could be audited, right? And so what do we look for in an audit? So an IRS agent is going to look for substantiation, nexus, funded research, base period, and everything else on here. So what is substantiation? This is the biggest part of an R&D audit or an R&D study. Substantiation is the documentation or the information that goes behind your claim, right? So you can claim an R&D tax credit on your tax return. It's in numbers. It fills out a number of lines. It's a bunch of numbers and it flows through on your return and it reduces your tax liability. You know, so what's behind that number? Prove to me that number is accurate. That is the substantiation. And that's what our firm specializes in doing, is helping you prepare that documentation and substantiation so that if you're audited, we can prove that that actual expenditure is a qualified expenditure. And this is why this is the credit that you're entitled to. That's where the IRS pokes most holes and where they throw out most R&D tax credits claims is in that substantiation category. If you can't prove that you're eligible for the R&D tax credit, it's going to get thrown out. I have seen a number of clients and a number of taxpayers out there that just try to calculate a credit and put it on their return. And when they get audited, they have no evidence of why it's qualified. So this is a big area. Nexus is another big area. That's also what we help a lot with our documentation package and that substantiation as mentioned. Nexus is the IRS wants to see you proving why this particular document or why this particular expenditure is connected to the item you're qualifying. So if you go back to that permitted purpose I was talking about earlier, what is the thing you're developing? What is it that you're proving? Is it a software application? Is it a widget? What is the nexus between the documentation and the expenditures and that widget or that software application? So proving that as part of that documentation area. The other things that I've listed here is more related to the actual computation and things you got to consider, which is probably a little bit too in-depth for this conversation today, but that's what people like me and Todd are here for. We understand all these rules and understand what we need to do, like what is funded research. You can't claim a credit if it's funded by somebody, right? A client may be paying you to do something, but if they're basically paying you regardless of result, then it's funded, right? It's not your research, it's their research. So they'll look into things like that. Business component, what is the item you're developing? I mentioned that earlier. What is the thing? Can you point to exactly what you're doing? What are you improving? What are you developing? Depreciable property, remember I mentioned that it's depreciable property is not eligible. You'd be surprised the number of companies, individuals that you that are trying to qualify machinery, equipment, and buildings and things like that, not eligible expenditure. Those are just things that to look out for when it comes to R&D tax credit. So substantiation, I mentioned that already, so I probably don't need to go over this slide. What does it mean? As I mentioned, it's just the evidence or proof that goes behind the R&D tax credit claim. So what kind of documentation do we look for? Well, there is no set rule of what is a qualified document or what is substantiation. The only thing in the rules and regulations is that you have to have permanent books and records, meaning you have to have a permanent way of documenting these things. It doesn't tell you what it is. You have to have X, Y, Z. So it's really a matter of experience and understanding what the IRS is looking for. And these are just example items that we look for. And every client, every industry is different of what they have on hand and what they track. There could be testing records, there could be project lists, there could be designs and drawings, there could be prototypes, budgets, lab notes, things like that. Anything that kind of proves that you're doing these kind of qualified activities, we help gather, analyze, put together into a format and summarize so that if the IRS will look at it, they can point right to the section and understand why this is qualified and why you're entitled to an R&D tax credit. So this is just an example of some of the documentation that we do look for. I was talking to Amy earlier about qualified, activities. I won't necessarily go through all these because I know a number of you may be involved in setting up and designing, facilities, kitchens, things like that. But we do a number of food and beverage client companies that actually are developing food products, and maybe some of you are developing food products. So I put in some examples that we see there in regards to developing an item, right? Whether it's a new bag of potato chips or maybe it's a new soft drink or anything like that. All that could be potentially qualifying activity, the actual formulation, the actual ingredients, the actual clean label initiative. We see that all the time. We're trying to get rid of the ingredients you can't pronounce, but make it taste exactly the same as it did before. Packaging, right? How do we extend shelf life? How do we make it more efficiently? That all can be qualified activity. So this is just some examples here of items that can qualify. Agriculture, tangentially related to food, right? If you're growing food, it can go into the food process. So again, it may not be applicable to a lot of individuals on the call today, but I do know you're tangentially related to the food and beverage industry, and agriculture is a big area related to the food and beverage industry. And this is just some examples of the type of activities that go on in the agricultural industry. And I believe Todd has a handout that I think he's going to share with everybody, or maybe Amy will distribute to people that goes through kind of some more of this type of qualified activity and example job titles.
Yeah, we will.
Okay, perfect. Winery, again, food and beverage. Same thing could be said for breweries. These are just some examples, test formulations, toxins, even software development in the food and beverage or winery can qualify as well. And then these are some job titles, right? Job titles is not indicative or is not determinative of if you're qualified for the R&D tax credit, if that employee is qualified for the R&D tax credit. It helps because that is the first thing the IRS does, is they do go look at the job titles of individuals that are qualified. And they may wonder, why is a CEO qualified or why is a salesperson qualified, right? So job titles do matter, but they're not determinative. They could just be indicative of the qualified activity. What matters is what is the actual activity. So the CEO or the salesperson may actually be involved with the qualified activity. And the important thing here is to be able to document why they are. Why are they qualified and what activity are they doing to be eligible for the credit? But it always helps to have great R&D job titles like software developer, engineer, scientist, things like that. Those are going to be less questioned than job titles that say admin or CEO or CFO. But that doesn't mean they shouldn't be qualified. They still can be qualified. It's just making sure we document as to why they are qualified. Okay, and then the last thing I'm going to go over here over the next couple minutes, and then kind of leave it open for question and answer if there are any questions out there, is the Chief Counsel Memorandum that just came out in October of this year. And basically what this states is historically, and again, this is going to be into kind of the tax weeds here, but it is very applicable to individuals that are claiming the R&D credit, whether you're a tax expert or not, is historically when you claimed an R&D tax credit refund claim. And the definition of a refund claim is amending a return for a refund. An original return filed on time is not applicable at this moment, although we do anticipate that the IRS is going to change that this coming year. Anytime you file an original return late, this applies to you though. So if you didn't file your return on time and it's the original return, you are going to be filing a claim for refund at that point in time, even though it is an original return versus an amended return. But that's who it applies to, is basically amended returns. Historically, companies or the CPAs of the individuals that are claiming the R&D credit would amend the return and follow the amended return process of basically saying, filling out the return and saying that we are filing an amended return to claim the Section 41, that's the Internal Revenue Code section of the R&D credit, Section 41 R&D tax credit. And that's all you had to do. You included what changed, you included the R&D form, and they processed it as such, and you got your refund or was audited or they asked questions, right? One of those things happened, and that's all you had to do. Well, now the IRS is making these taxpayers provide all this additional information to make a refund claim. So what they're saying is you got to identify the business component. The business component is a fancy word for the item, right? The widget, the software application. You have to define every single one of those, whether it's like we're increasing the speed of this process, that's a business component. We're developing this widget, that's a business component. They want to know every single one of them. For all that, for every single one of them, they want to know every single person that was involved with that business component and what were they doing? What was their actual activity? And what were they seeking to discover? What was the technical information they were trying to solve, right? How are they trying to design it? Or what was the method they were going to use? All this information is now being required by the IRS, which is changing it drastically. So all those companies and individuals that were doing it just one-off on an individual page and submitting it with their tax return, all this information is now going to be required. And that's also what we help with, right? Is making sure that you have all the right documentation and all this information.
This is Penny.
I'm sorry?
Good, how are you?
What's going on? Did someone ask a question? I'm not sure.
No,
Am I the only one here?
I'm not sure what's going on. Let me double check this. Keep going.
Okay, no, I'm almost done too, so that's a good thing. But all that to say is you're required to provide all this additional information when you amend your return. So this is a big change, and it's asking a lot of taxpayers to provide this information. So we do expect it's going to be challenged, probably challenged in the courts. But as of now, this is how the IRS is going to review and enforce these R&D studies until they're told by the courts they can't. So that's something to keep in mind as well. And we've always provided this type of information in a study. Anyone that engages us, we provide this information because it is required. It just was never required to be actually put on the tax return. It was just required to have in your files to substantiate your claim, like anything else on your tax return. you have to have a file as to why you're deducting, a software license, right? You got to have an invoice that was billed from them to prove that you're entitled to that deduction. This is the same thing. So the last thing I'll just point out here, it's not actually tax law, it's just administrative from the IRS. This is how they're going to view it. And again, the courts will decide if this is legal or not, but we do have to follow these rules because that is how the IRS is going to view these returns in the future. Also, as I mentioned, this is only on immediate returns right now. We do anticipate that the IRS will probably this coming year, 2022, start making this required for original returns as well. But what they'll do there, instead of asking for this information, is they'll just update the R&D tax form in the tax return that has spots and sections where you put this information in. So there's going to be lines and things like that you're going to have to complete for those particular claims. So wanted to throw that out there because that is a big administrative change and could impact a lot of individuals that may have not been collecting this information to start with. But it is going to be a part where the IRS is going to allow it disallow it completely. Any claim does not meet these requirements. And that's what they've outlined. They're just going to reject the claim outright and not even audit it. They're just going to say you didn't do it right administratively. So it's all going to go out. So that's going to be a problem, I think, for a lot of people and don't want to risk any statutes of limitations closing where you miss out on money because it was just rejected because the right information wasn't presented. So that I know was a lot, and I did get into some of the tax technical stuff that may or may not have been interested for you, but I thought it was important to kind of point some of the things out, like this Chief Counsel memorandum. But I will kind of stop there and see if either Todd or Natalia or Amy, you want to add anything, or if there have been any questions that have come in.
There's been a few questions, but I've sort of been going back and forth in answering those as they came in. But that was, going back to the business component memo. Someone brought up they were creating new recipes and developing new 10 new soup flavors, and that's where, yeah, that's absolutely R&D. It's like, especially if one of those doesn't taste very good the first time, that shows R&D.
And I'll just kind of point out here, just again, this is the tax, the tax geek in me coming out. I am a CPA and tax by background and all that stuff. Coming out is taste and preference is not an eligible activity. So if you hear people say taste and preference are not eligible, that is true. Taste and preference is not an eligible activity. So if a consumer prefers A or B, that is not an eligible activity. However, the science behind making something taste good, or how do we make it taste this way, that is an eligible activity. So if you're developing 10 types of soups, you're trying to figure out the salt content or the right way to, temperature that you need to boil it at and can it at and things like that, all eligible. Even though at the end of the day, you want it to taste good, that's still going to be an eligible activity. It's just the taste of a consumer prefers red or blue, that type of thing. Or marketing, the consumer prefers the sour cream and onion versus cheddar chip, but developing the sour cream and onion or the cheddar, and how do we make it taste like sour cream, onion, and cheddar, that is an eligible activity.
Right, and you look at it, that same person was asking, well, can a chef or a mixologist be considered a qualified job title?
Yes,
they're considered they can be the technical experts in those areas, right? If they're making soup, well, a software developer has nothing to do with soup. Chef does, mixologist does. So yeah, that's a good one.
Yep, I had a potato chip manufacturer. I've had a lot of food and beverage clients, but the potato chip one always sticks out on me. And they actually had chefs on staff, and they did more than potato chips. They also did snacks and things like that as well. But yeah, they had a chef on staff that helped in a test kitchen to develop these small batches of what are they going to develop and what are they going to package and sell to people.
And I know some of the people that are on the call, they design like food courts or kitchens or for either public entities or other areas. What about those people?
Yeah, so that, even though it's related to the food and beverage industry, right, the actual activity that be qualifying there is going to be engineering and architecture, right? which is definitely a qualifying activity. So if you're designing a food court or a food hall or anything along those lines, it's going to be more about the design, right? The engineering that went behind it. So those can be qualifying activities too. So the schematics that you're developing, the CAD modeling that you're doing, like how do you make a certain thing fit in a certain place that requires certain humidity requirements and things like that. That type of activity could potentially be qualifying. So engineering and architecture is where I would think that particular activity would fall into. And engineering architecture can qualify for an R&D tax credit.
So we just had a question. How about cannabis and CBD topicals?
Yep. So cannabis is interesting. Yes, it's still an eligible activity. If you go back, I kind of flew through the example slides of food and beverage. Agriculture is one of the ones I put up there. Cannabis is agriculture, right? You're growing cannabis. It grows in the ground like any other vegetable or plant. So yes, you can still be performing qualified activity for cannabis, crop yield, things like that. How do you get the best strains? How do you, how long does it need to be in light and how bright of light? Things like that, all qualifying activity. Now, I'm not an expert in what I call it's called 280E in the tax code. I'm not an expert there, but I want you to be aware of it. So there is a code section out there in the tax code that basically says no credit or deduction is allowed for any individual involved in the trafficking of Schedule I drugs. Cannabis is still a Schedule I drug. So for US federal purposes, you still are eligible for the R&D tax credit. And I actually do, as a firm, we do have a couple cannabis clients. You're actually eligible for the credits, but you just may not be able to claim them currently. And they're banking these credits for future use is one thing. Because for federal purpose, and this is where your CPA with your discussion with your CPA would be important because they're going to know more about it. But they still are performing eligible activity. You still can qualify for the credit and you can still calculate the credit. And so there's different things you can play with in the cannabis industry to see how you can make sure you can utilize the credit in one way or another. But there is that provision out there I want people to be aware of. However, CBD is different. It's not cannabis, right? That is just an eligible industry as long as it's not Schedule I. And there is a definition of what Schedule I is out there. I don't know it off the top of my head. And the THC level has to be a certain amount or above for it to be Schedule I. If it's below a certain amount, it's not a Schedule I, and CBD is generally under that amount. So you should be fine there. And the other thing I would say is, to the extent it is a Schedule I drug, let's say it's a cannabis grower, you claim the R&D credit for federal purposes. Most states require you to claim the federal credit as the first step in being eligible for the state credit. A number of states allow you to use the credit, like California allows you to claim the credit against cannabis, right? Because it's legal there. So they're allowed to utilize the R&D tax credit in California. So a lot of people calculate the credits because they just want the state credits. So that's the other thing to consider too, is what state are you in? And can you use the R&D credit for that state to offset taxes there? But that was a long way to say is yes, cannabis is eligible for the credit.
All right, and John, we just had one come up to where when you have a food service consultant that's part of the design team, how would that work as far as who gets the credit, or would the consultant get a portion of the credit, or is the architect?
Yeah, so that goes back to when I go to what is a disqualifying activity in funded research. I alluded to that a little bit earlier. So the R&D credit is intended to be only claimed by one person on the same, or one company or entity on the same exact activity, right? Both sides cannot claim the activity. So when you think about contract research, whose research is it, right? So you got to look at what is the underlying activity, and then what are the expenditures? So if you're a food service consultant helping somebody develop something, whatever is being developed is the thing that's being qualified. And the food consultant has to determine, am I an eligible contractor of theirs, or is this my activity? And what that is, it's based on the rights and risks of your contract. And so in order to claim the R&D tax credit, you have to retain what we call substantial rights to the development of the activity. So the item that you're developing, the whatever it is that you're working on, you have to retain substantial rights to it and bear the economic risk to it. And depending on who has substantial rights and bears the risk is the person or the entity that claims the credit. Substantial rights does not mean exclusive rights. It can be shared rights. All that means is you have the right to use the technology or know-how that you've developed. And you have the right to use it in your trade or business, and you do, and you don't have to pay for that right, then you retain rights to it. It's more the risk where we see most people disqualified, and occasionally we do see rights disqualifying, but risk is who's at risk for the development, who's at risk of loss, who's at risk of failure for this. And if the food consultant is going to get paid regardless if the item fails or succeeds, then the consultant's not at risk.
So when you talk about who's getting paid, what are you talking about there? Are you talking about like the way the contract, like time and materials versus fixed fee, or how does that work?
That's indicative. The pricing is indicative of who bears the risk, but also there's terms and conditions and contracts that would be determinative if you're at risk of that as well. So if you're a consultant that's being that you're billing out at time and material basis, and the person's just paying you on a time and material basis, then you're not at risk because you're going to get paid regardless of how long it takes you to do something. If you are getting paid a fixed fee and you have to make it work no matter what, even if it takes you 50 hours versus 10 hours, you're at risk, right? For those 40 extra hours. But if you are at risk for that amount of money and you have to make it work and you don't get paid, right, then you're seen at risk in that circumstances. So the fee structure can be indicative, but it's not determinative. You got to determine what is actually going on within the contract and where does the risk lie? Who's at risk of losing money if something doesn't work?
Right. And just so everybody knows here, it's a part of the reason why we're invited is we're able to help one of the members of your group with the R&D tax credit, and they were a food service consultant that did mostly designing of kitchens and commercial, food halls per se. So yeah, so going back into it was Chris Clements that was making that comment here. Going back to your question, Chris, yes, you guys can, but it is determined based on all the factors that John just mentioned. But absolutely, yeah, it can be a good one for you.
Okay, we're right up against the end of our presentation time. So I just wanted to say, first of all, thank you again to John and Todd for participating today and for all of this information. We will be able to put people in touch with you, I hope, if there are questions. We've had a lot of questions and requests for slides, so I'll keep that in mind and let people know how to get a hold of you. And again, for our members, again, let's just finish by saying thank you to you all for participating. Thank you to everyone for joining us today. Remember that we have these Business Essentials. Now we're moving to once every other month, but our next event will be in January, on January 19th at 3 p.m. Eastern. As I said earlier, don't forget that you can access all of our Business Essentials webinars on our website and that they do qualify for credits, for CEU credits. Also, don't forget we have an On Tap series that will begin again in January at the beginning of the month. So keep an eye out for messages about those events and those recordings. And finally, we are so looking forward to seeing you all in Montreal, April 21st through the 23rd. So keep that in mind, make sure those dates are on your calendar, and you can learn more about the conference at fcsita.org. That's where all the information about panelists, sessions, dates, times, registration rates can all be found there. So again, thank you all for joining us. Thank you, John, Todd, and Natalia for being with us today. And I look forward to seeing you all again soon. Take care.
Right. Thank you.
Appreciate it. Thank you.